Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And again, this episode is recorded on YouTube. So for whatever reason, if you want to watch me record the episode in video format, you can certainly do that over on YouTube. Okay, let's get into today's episode. And I want to talk about relying on property sales data. So there's more property sales data available to investors than really ever before, and much of it is free. So to, find out how much 13 Smith Street, for example, is sold for or transacted for over the last few decades, that's relatively easy and cost effective to find out. And of course, we can then analyze, how that property value has changed, compare it to similar properties that are in the surrounding area. And that can be a very important part of the due diligence process to ascertain whether we're investing in an asset that's going to generate the level of capital growth, level of return that we're really looking for. But the problem with this approach is becoming too data-driven can lead to mistakes. So, over the past sort of 5, probably even 10 years, there's been certainly a surge in buyer's agents, many of whom are borderless that can buy property across Australia. And these tend to be data-driven buyer's agents, but also there's almost a false sense of security for individuals that aren't advised, that don't seek the advice from a buyer's agent, to look at this data and start drawing some conclusions. And what I want to do is not dissuade you from doing that due diligence. It's a very important part of the process. But what I want to do and talk about today in today's episode is some of the things that you need to consider. And if you don't find enough data points, what to do as a result of that. So let's zoom out a little bit and really understand how this fits into the bigger picture. And I've spoken about, what makes a property investment grade in the past. And I've spoken about that there's 3 attributes that a property must possess to be considered to be investment grade. The first one is genuine scarcity. So scarcity in terms of twofold. Firstly, in terms of land supply, so that there's not enough land or there's no vacant land in close proximity to that location. So that is, land supply is fixed. Of course, we're not, can't make any more land, but all you can do is travel further afield, out to the outer suburbs, of course. And then ideally, secondly, in terms of scarcity, a property should have some sort of feature or uniqueness that creates additional scarcity. So that could be architectural style, it could be an Art Deco style building. They're not producing any more Art Deco style buildings, or period architecture, water views, highly desirable street or school zone, something that's kind of unique that creates that scarcity. So that's the first attribute. The second attribute is that you want a strong underlying land value. So the more land you have, in terms of the value when you first purchase the property, the greater the amount that you can spend on the underlying land and getting a quality location, the greater the probability you're going to achieve a higher capital growth rate. And of course, I've spoken before that, when we go and purchase a property, we should be predominantly just focused on capital growth. Spend all the money on the land, not the improvements. We can always improve a property in the future, but you can never really change land location and size, of course. And then finally, it's got to have runs on the board. So in other words, the property must have demonstrated it has the fundamentals, the attributes to drive strong capital growth over several decades. So we're not throwing darts at a dartboard. We're not trying to pick the next growth suburb. We're saying, okay, this property has generated 8% compounding growth over the last 40 years. And that gives us, there's no guarantees, of course, but it gives us a high level of confidence that if we invest in that property, probability is, it might not be 8%, but probability is it's going to be something pretty attractive relative to other properties that I could invest in. And it's this final attribute, the runs on the board, that I'd like to talk about today in terms of how do you build that data set and some of the weaknesses associated with building a data set and what you can do about it. So let's use an example, and I pulled out a sort of example property to sort of just walk you through how would you go about producing this data set and looking at past growth. So let's say I'm interested in buying 13 Smith Street. It's a 2-bedroom Victorian cottage house, on 200 square meters that's received some cosmetic renovations over the past 20 years or so. So it's in good condition, but it's not brand new. And a property like that's most likely in a blue chip suburb, most likely to be mostly land value, maybe 70 or 80% of the total value of that asset would be in its underlying land. So this is the sort of property we're going to talk about, just so you can kind of picture it in your head. The first thing that I would do is go and have a look at the sales history for 13 Smith Street. And then I can use an online calculator or the XIRR formula in Excel. Even ChatGPT will do this. And what I'll be able to do is calculate the compounding annual growth rate over different periods, depending on how many transactions there've been over the past number of years. Now, one, you want to make sure that you're using a tool that's going to give you all the data, or at least ask a buyer's agent or a real estate agent if they've got access to past sales history of that particular property, particularly if you're working with them. And so finding that data is, the first step. And hopefully what you'll find is that the property is sold many times. What I've done in the blog on the website, and of course there's a link in the show notes for that, is I've just randomly picked an investment grade property in Melbourne. And what I've done is it's transacted 4 times over the last 40 odd years. So the first sale was in 1986. It sold for 88,500. It sold in 2000 for 440,000. It sold in 2010 for 940,000, and the most recent sale was 2022, 1.63 million. So we've got 4 data points there. And then what I've done is calculated the compound annual growth rate. Again, you can use ChatGPT or the XIRR formula in Excel to do this. And what I've done is calculate over different time periods. So I look between 86 and 22. The compounding growth rate was 8.5%. And then what I've done for each of these periods is compared it to the median growth rate of houses in Melbourne. Because what I need to do is I need to have some sort of benchmark to compare it against. So over that 36-year period between 86 and 22, it achieved 8.5% growth, and the median house price in Melbourne appreciated by 7.1%. So we've had 1.4% higher growth than the median. That starts to build a bit of a data set to make us feel pretty happy and confident. Between 2022, so that's 22 years, of course, 6.2% growth. The median was 6.1% growth. So we've outperformed the median, but the numbers are certainly changed quite a bit. If you look at the most recent 2 sales, which is between 2010 and 2022, that's only a 12-year period. We've only got 4.5% growth. And in fact, the state median grew by 5.2%. So we've underperformed the median over the last 12 years. And I went for the middle band from 86 to 2010, 10.7% growth compared to 8.1% growth for the state median. And if you look at the median values, you aggregate all those numbers, you look at the median value, looking at all those different data points. And this is what we're trying to do, is we're trying to build a big data set. And if I'm confusing you with all these numbers, maybe the best thing to do is have a look at the table on the blog on the website. Again, the link is in the show notes. But the median over those periods of time, because the issue is that some periods are going to be very high growth periods. The most recent 12-year period, of course, it's important to benchmark to the overall market, because Melbourne's property market has been pretty subdued growth-wise for the last 10 years, of course. So that gives us some context. So the median, well, it's got the midpoint of all those numbers. For the property, 7.3%. For the state, 6.6%. So we've got about a 0.7% outperformance there. The numbers don't really matter that much. It's really the trend that we're looking for. And what our thesis is with asset selection is that if we apply a whole bunch of time-tested principles, that we should allow us to buy a property that is above average quality, and as a result, our return should be above average. And so what we're trying to do with this data is test that thesis. Has that property actually had, enough attributes to sort of drive those outcomes? Now, that's for 13 Smith Street, which is our target property. Once I've done that analysis for 13 Smith Street, I would then look at 11 Smith Street and 15 Smith Street. So the two properties either side of the target property. And of course, as long as they are comparable. So I would be looking at sort of land size, whether they've been renovated, the size of the dwelling, those sorts of attributes. And if I thought they were comparable, at that very high level, then I'd go and look at the data. And I do the same sort of thing, look at the past sales transactions, impute or calculate a compounding capital growth rate, benchmark that to the median, and then I'd work my way down the street. So then I'd look at number 9, number 17 Smith Street. I'd look at across the road. I'd just try and find as much data as I possibly could. And this process of building that sort of data set gives investors some confidence about, whether it is the right property, whether it is the right location, whether it's going to make a great investment and so forth. So that data this analysis is very important in helping us make great quality investment decisions. However, it can lead to expensive mistakes. And you don't want to be just purely data driven because you can't necessarily rely on this data 100%. And so what I wanted to do is spend the rest of this episode talking about why that might be. And therefore, if you understand, what's driving the data, and you've got to do a little bit more due diligence to achieve that, and you might not actually have the knowledge and experience to do it yourself. But if you understand, the shortcomings, the potential shortcomings this data could have within itself, you can then really understand how it could lead to a very expensive mistake. So, expensive mistake, it could be buying the wrong property in the right location. So you get the location right, but the property's not suitable, or worse, it's the wrong property in the wrong location, and you're going to forego a lot of capital growth over a long time, or give rise to avoidable transaction costs in terms of buying and selling costs if you end up making a mistake. Okay, in no particular order, let's talk about the things that can skew data. The first one is timing. And this is why I think it's important to benchmark it to the state median. I wouldn't benchmark it necessarily to the suburb median. I've spoken before about suburb median data, and it's not always statistically reliable. Depends on the size of the suburb, the types of properties that are being selling in that particular time. I prefer to benchmark against the state median. You're going to have it's a much bigger data set, more reliable, and we're not really too worried about the actual number in terms of what is the median value of a house in Melbourne in 1990. It's really about the trend. And what we're trying to do when we're benchmarking trends is just trying to see is it in a growth cycle, is it in a flat cycle? Because if it's in a flat cycle and property hasn't changed in value, whereas mine has increased, then I'm pretty happy, even if the increase is pretty subtle. And that was in the example that I used, the growth between 2010 and 2022 was only 4.5%. Again, that's not a great outcome, and it was less than half the growth rate between 86 and 2010, so the previous sort of period. But again, if we benchmark it, we kind of understand what's going on. Now, if you don't benchmark it, the problem might be that, if a property was bought just before a growth cycle, then of course the capital growth rate's going to look good. And it might entice you into thinking this is a great asset because look at its past growth, but the timing might have just been perfect. Similarly, you might look at an asset and go, actually the growth is really poor, but if it was bought just before a prolonged flat cycle, for instance, well, of course, maybe it's understating or undercooking the growth rate. So that's why benchmarking is really important. You need to have context to compare these things. And what you do want to see is that generally the property is outperforming the median. Now, it can be periods of time where that doesn't necessarily happen, but that's why you need to then look at 13 Smith Street, 15, 9 Smith Street, etc., as long as you're looking at these comparable properties, because then you build a bigger data set. Just looking and relying only on the target property sales just isn't enough. And again, the reason for that is that, some of the things that I'm about to talk about will mean that data set or those data points don't necessarily reflect the intrinsic or true value of the property. So market cycles, market timing, when those transactions occurred within the property cycles can either understate or inflate potentially the capital growth rate, or what reasonable capital growth rate you might expect. The next thing can be unusual market activities. So sometimes locations can be influenced by sort of a temporary surge in demand coming from a single source of buyers. And so a really good example of this is if you've got a prominent buyer's agent firm and they start to recommend a particular suburb or hotspot, that might end up attracting a wave of investors into that location. And that short-term demand can artificially inflate prices and distort apparent growth rates. So, you can start thinking, gee, this is a great place to invest, but it's really just because this firm's been pushing a lot of their clients into that location. And it certainly does happen. And what you'll find is then when you talk to locals in that area, they can kind of recognize this sort of strange uplift in values, and you want multifaceted demand. So you want property prices pushed forward by lots of different types of buyers, certainly not only investors. In fact, if a location is driven primarily by investors, to my mind, that's a red flag, because sometimes that can lead to speculation and artificially inflate prices as well. Another, small, yet still relevant example of how unusual market activity can skew data was back in October 2008. The Rudd government at the time doubled the first homeowners grant from 7,000 to 14,000. And, any properties that were priced less than 600,000 at that time experienced a notable spike in values. So, and again, at that time, you had a lot more sales at that sub 600 level just because of the spurt from the first home buyers grant. So you've got to be careful. You've got to have that local area knowledge, understand what was occurring at that time, and then that gives you some context or builds a little bit of a story, if you like, behind the numbers. The next thing to think about in terms of looking at data is whether the property has fundamental flaws. So what I'm talking about here is not just your subject property, but if you're looking at, again, 13 Smith Street, comparing it to number 11 and number 15 either side, for example, and you're starting to, if you want to make an assumption that those properties are comparable, you absolutely need to make sure they're comparable. Whereas sometimes data-driven models will look at all the data they can possibly look at and just assume that these properties are homogenous, that they're exactly the same. That can lead to problems. That can lead to mistakes. So what am I talking about in terms of fundamental flaws? It could be things like poor privacy or security, road noise if it's closer to a main road than the subject property, poor orientation on the block, proximity to commercial buildings, an architecture style that clashes with the surrounding streetscape. So, if there's a lot of weatherboard homes and then you've got a brick home, or vice versa, an awkward floor plan, these sorts of things, these sorts of characteristics can result in a property underperforming on a capital growth perspective and sometimes understate the growth rate. And you want to know about these things, because if you're looking at, two different properties and comparing them and one has really underperformed, you might draw a conclusion and say, no, that location's no good, that property's no good. But in fact, if there are some fundamental flaws, you need to uncover them, because that'll tell you whether that data whether you should be actually influenced by that data, of course. And of course, no two properties are ever identical, and there's no such thing as a perfect property either. Every property is going to have some sort of attribute that isn't ideal, and every property is going to be different. So there's a bit of subjectivity to these sorts of things, but it's really about digging a little bit deeper and not necessarily just taking that data on face value. The next thing is capital improvement. So of course, what is not apparent in these sale transactions is how much of the improvement in the sale price was driven by the underlying land value versus some improvements in the property. And, we can be at lots of different points at the scale in terms of improvement. So you could have a property that's in complete disrepair, complete original condition, if the house or the dwelling is, 70 years old and really has had nothing done to it, that's a renovator's delight, if you like. You could have a property that's just been maintained relatively well. It's not shiny and new, but it's occupiable or tenantable, versus you could have a property that has been almost fully rebuilt or even potentially knocked down and completely rebuilt. And none of that's going to really show up in the data. It's not going to be easily to identify, what contribution the capital improvements have made. Now, when looking at the data, of course, you've got to look at the photos, and on RP Data, which is a Coality product, you can see the photos that we used in the sales campaigns, in the past. So I can go and have a look at the photos in 2022, for example, and the photos that we used in 2010 and see if the property has been renovated. And if the property has been renovated, then you're going to need to make some sort of allowance for that when you calculate the compounding capital growth rate. And again, you can do that in Excel using that XIRR formula. And all you do is work out, well, when was it renovated? 2015. I estimate the cost of the renovation just roughly 350,000. So I'm going to include that when I calculate the compounding capital growth rate. Again, it's not a perfect science, but I think completely ignoring the impact of capital improvements in the appreciation of property prices will again lead you to make a mistake. Next, I want to talk about location nuances, and really there's a lot of subjectivity with property, a lot of nuances that go on. So, there's within a particular suburb, there's always going to be favored streets, the perfect streets. Maybe one side of the street performs better than the other side of the street, maybe because of sunlight or views, superior views, water views, those sorts of things. Maybe one side of the street is backing onto parkland, or maybe one side is backing onto commercial property, or one side offers better privacy or security, or maybe one's in a school zone, one's not in a school zone. These are the sorts of nuances that occur in many suburbs around Australia that you really need to understand. And so, comparing a property in one street to the next street, or even a property on one side of the street versus the other side of the street, may not be a fair comparison. So it's really important to understand those nuances if they exist, and make an adjustment for your sort of data analysis. Next, talk about sort of zoning and heritage overlays. So if there's been any sort of changes in zoning, this can work in both directions. Of course, if there's been a relaxation of development zoning rules and so forth, that can increase the productive value of the land, so that can have a positive impact. Conversely, in depending on the purchaser, they might view that as a negative. If I'm going to go into a street where there's been period properties and the streetscape has been attractive from that perspective, and then if planning rules are relaxed and that results in more, medium density style apartments or whatever, it's going to change the streetscape. So it might not actually benefit. But you've got to understand whether these things have occurred and work out, what sort of adjustment that or impact that's had on growth. Because you don't want to extrapolate those sorts of things. If a rezoning has occurred, or maybe a relaxation of overlays or something like that, that's been a positive, that might give a one-off kick. But you don't want to extrapolate that one-off kick to then think, well, that's the sort of growth rate I can expect over the next few decades. So again, it's understanding that local area, that local market. Lastly, gentrification and significant changes in local amenities. These things are really important. Again, these quite often can result in either periods of above average growth, and then it tends to sort of level out. Or you might be looking at, for example, Richmond's a good example for those that are familiar with Melbourne. Richmond was very sort of industrial in the 80s, and it wasn't a particularly desirable place to live. So when you have a look at growth rates that, go through a period in the 80s, it's probably going to understate the growth. Whereas then it sort of gentrified, certainly early 90s started to do that. Now it's a very livable suburb, and you wouldn't really describe it as sort of industrial anymore. So if I was going to look at growth rates in Richmond, I'd be inclined to exclude what happened in the 80s, because it's a much different suburb today than what it was then. It's not really comparable. So similarly in, new build areas, and this, I don't advocate investing in new build locations just because of the scarcity component, which is one of the three attributes that I spoke about at the beginning of today's episode. But let's talk about it because, sometimes property advocates or blogs and these sorts of things talk about, look at the great results investors have enjoyed by investing in such properties. But if you think about new estates, quite often they experience strong growth as an area becomes more established. So, in a new build area, you normally have different land releases. They don't release all the land at once. Stage 1, stage 2, stage 3, etc. If you buy at stage 1, typically you're going to buy relatively cheaply because there's nothing in the location. It's a paddock. But as time evolves, they'll build a school and they'll build more amenities, some healthcare, a supermarket, all those sorts of things. So as a location matures, the value of the underlying land increases. And so the price for a block at stage 1 is going to be much cheaper than the price for a block, for example, at stage 3. Now, the issue, though, there is you can't go and then just extrapolate that growth rate and go, wow, this location's enjoyed 10% growth over the last 5 years. It's a great location to invest in. What tends to happen is once that area matures, growth will be more in line with inflation. And then as the next land release in the next adjoining suburb or paddock starts to get released, and the same thing happens again. So understanding those market cycles and understanding what has happened in a particular location, and do I need to adjust? Has there been events or situations, either in a positive or negative direction, that I can't therefore extrapolate that past growth? Because, there's that disclaimer that is often used in share investments, past performance. That is, the disclaimer is past performance is not a reliable indicator of future performance. And that is certainly true. But with property, it tends to be a reliable indicator because the factors and fundamentals that drive property values tend to be both factual, so that it's a question of fact. There's no subjectivity in terms of land supply, orientation, amenities in the area. They're a question of fact, and they tend to be static. So these things don't change over time. The location of a train station, proximity to a hospital, proximity to a local shopping strip, all those sorts of things. They've been there for the last 40 years. They'll be there for the next 40 years. So to that extent, the past growth can actually be a reliable indicator of future growth, except for, these events that I've sort of just spoken about, or factors that I've just spoken about that you need to really then think about. Okay, so if you're in a tightly held suburb or you're looking at a particular subject property and there isn't a lot of data, it's going to be really challenging to build enough data to make a reliable decision. So when you look at something statistically meaningful, you've really got to have about 30 investigated transactions. So 30 transactions of the subject property and similar comparable properties surrounding it that you've looked into. You've considered all the things that I've spoken about in terms of renovations, whether there's any local nuances, whether there's fundamental flaws with the properties, whether there's unusual market activity, all the things that I've just spoken about today in today's episode. But actually, for it to be statistically reliable, you probably need 50 data points. So it's really 30 to 50 data points, if you like. That's going to be really time consuming and really difficult to find. And so I guess what I'm saying is that I think in most situations, there's not enough data to make a data-driven decision alone. In fact, therefore, you do need that local area expert. And so I think the data process to selecting a property and even if you've got existing properties and you want to, consider whether they're going to be good quality assets to hold on to, the data part or data step to that, which I've just discussed today, is a very important step and something that I believe investors should look into and do that analysis. But I would say for most situations, that alone won't be enough. And what you then need to do is really consult with someone that has that local area knowledge, that understands the nuances in the area, that can apply I say properties part art, part science. So the science bit is the data. We can do that, but the art bit is really understanding the local knowledge. So I wanted to record this episode because I think it's really important. Sometimes we can become too data driven. Sometimes we feel like, oh, we've looked at all these properties and this has been the growth rate, so we're now really confident. But I think it can lead to mistakes. And I think some buyers agents are going to use that data to their advantage in terms of recommending a particular location. And I'm not saying they're doing it in a way that's purposely misrepresenting the recommendation. But what I'm saying is that you just want to be really critical about it, and you want to delve into that data, make sure it is reliable, and then understand or ask yourself, is there a large enough data set here that's going to give me confidence, or do I need to consult someone with local area knowledge? Okay, let's get into some questions today. First question is from Lincoln. Lincoln's asked, in fact, I'll just read it out. My wife and I bought an investment property, joint tenants, so it's in each other's 50-50, if you like. And to have a better yield, we've decided to rent it out room by room. As you would expect, renting out room by room carries much more work, more admin, and my wife does everything herself. I'm in the high income tax bracket, 47%. She's in a lower income tax bracket of 16%, but is currently on maternity leave. Is there a way for us to properly remunerate her for the work at the same time to be tax effective? The property is negatively geared as we borrowed 105% of the property using equity in our home. Well, Lincoln, yes, of course you could pay your wife, so that is you as the owners, you and her, can pay her a market level fee for managing the property. Of course, that would be 50% of that fee is going to be tax deductible to you. 50% of the fee will be tax deductible to her, but 100% of the income will be taxable to her. So I think it will help you, it could help you, potentially from a taxation perspective, but whether it's going to move the dial that much just because, the 100% of the taxable income will end up in her name, but you get each 50-50 deduction for the income. I'm not sure. You'd have to do the numbers, and it would have to be a commercial fee. So, you would document that to have an employment agreement potentially and do a bit of research to see how much boarding houses, property managers that look after boarding houses, which is probably the best way to describe this property, are paid. So you could do it. Whether it's going to result in a major tax benefit and it's going to result in more administration, of course, is yet to be seen. So I would just speak to your registered tax agents, whoever puts your tax returns together, in regards to doing that. And as a general rule, I say, or I advise most people, speak to your registered tax agent, because you really want to take advice from someone that has to live with the consequences, and what your tax agent agrees to do or recommends you do, they're going to live with that consequence in the future. So if it doesn't work out or the ATO pushes back, they're the ones going to have to deal with that. So that's really the best way to get that advice. Just a quick one on boarding houses. I haven't come across one for a while, but sometimes these properties, they'll come up, they're large houses that have been renovated, and they might have sort of a communal kitchen, lounge room, maybe shared bathrooms. Sometimes they've been renovated where they've got their own bathroom, like an ensuite, and there might be 5-10 rooms in a property. Sometimes these things, we come across these things, and of course investors are interested in them because the yield is substantial. The expenses are much higher as well, and as Lincoln suggests, there's a bit more property management going on, so they're a bit more of an active investment. But from a income perspective, they're great from an income perspective. I think a property like that is fine. Like if I had a client that was interested in something like that, fine, as long as it became a boarding house after you bought it. Because if you're going to buy a boarding house, typically they're sold off the back of this higher income. So that is the intrinsic value of the property in terms of its land and improvements might be worth, say, $1 million, but because they're marketing it as a very high yield asset, 8%, whatever it might be, they might want $1.5 million. So you really, part of that income profile is reflected in its higher price. In that situation, I wouldn't pay for it. So, but I would go and buy the $1 million property and then potentially convert it into a boarding house. Having said all that, you just need to make friends with the fact it's a lot more work. And, sometimes people get tired of owning investment properties because, you have periods of time where you don't really hear much from the tenants, but you also get periods of times where there can be a lot of changes going on. So just be careful and be wary and have reasonable expectations there. I digressed from Lincoln's question, so it wasn't really related to his question, of course. Okay, I might leave it there today because the next question is from Nick, and it's a very, very long question, so I might leave that to next week. All right, thanks very much for listening. Until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.